Good Tuesday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. I am moments away from a big chat on the future of oil with the CFO of Phillips 66. The company has spent a good chunk of this year trying to fend off or a feared activist investor in Elliott Management. I'll drill into what this company has planned for 2026 with oil prices well off their annual highs. Here's our rapid fire on what I'm thinking about right now, though. The jobs numbers for November are out, showing an increase of 64,000, but that borders on irrelevant, I think. Here's what matters, though. First, hiring has been little changed since September, and two, payrolls for August and September were revised down by a total of 33,000 jobs. These figures put new pressure on the Fed to stay the course on rate cuts out of the block next year. Tesla shares are still trying to close at a record high after failing on Monday. The last record close for Tesla of $479 came on December 17th, 2024. The stock is still up an electric 18% in the past month. With the pop in the stock, Elon Musk's net worth has climbed to more than 600 billion times. Clearly tough times for Elon. Speaking of cars, Ford is taking a $19.5 billion write-down on its EV business as it scales back its EV ambitions, with people still opting for gas-powered cars. Normally, I would say this write-down is super embarrassing for a storied company like Ford. However, I will stop just short of that, as GM is expected to report a big EV write-down in the fourth quarter, and the EV market has basically totally collapsed. A black eye for Ford and GM nonetheless. Tracking the AI trade, a day after OpenAI secured the Yahoo Finance Company of the Year award, I am looking at AI from a different angle. Sell-offs in two very prominent names. CoreWeave lost a shocking $33 billion in market value in 6 weeks alone, and the post-earnings slide in Oracle rages on, with shares plunging 17% in the past two sessions. Here on the Opening Bid Roundtable, Chad Morganlander, Washington Crossing Advisors Senior Portfolio Manager, alongside Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. Chad, coming to you. Jobs numbers. Has this done anything for you in terms of reinforcing a view that I think the marketplace has, that we need more rate cuts from this Fed, and in January, that's what they have to come on here and deliver?
Well, we definitely don't need rate cuts. The credit spreads are at historic lows that you haven't seen only a couple of times in 35 years. So it's really not essential to cut rates. With that said, we believe the Federal Reserve, though, will do the opposite. They will be extremely dovish going into 2026. I think I give it a 50-50 toss-up between a 0.25% rate cut, but I do believe that they will start to message in a much more dovish tone as you see a new candidate come and emerge out of the White House.
Are you not concerned about jobs not being created at a rapid clip, though?
I am concerned that there's a deceleration of economic activity, but overall, we believe that there will be somewhat of a fiscal thrust in 2026. And if you get some transparency on trade issues, that too will be a tailwind for the economy. I am also concerned, though, that inflation is stubbornly above 3%. That could be a bit of an issue if you see a more dovish Fed chairwoman or chairman come in. That response on the long end of the curve may be very, very concerning.
Brooke, anything to get excited about in these retail sales numbers that also hit?
I mean, retail sales, when you take out the spending on auto parts, on car spending, they did see a pop of about 0.4%. That was more than what economists had expected of a 0.2%. But with the purchase of cars, which saw a decline of about 1.6% during the month of October, then retail sales came in flat, and economists had expected a 0.1% pop. And where we're seeing consumers go, or retailers that you would largely expect, it's food and grocery stores, it's general merchandise stores, it's even furniture stores. And what they're not spending on are things like building construction and also perhaps, more expensive vehicles, it seems, as well.
And as if the economy doesn't need another rate cut, why are Costco pizzas flying off the shelves? You sent me some great research early in the week. I mean, it made me chuckle at first. But you've been on the pulse of this story literally the whole year.
Yeah, that's right. And that research came from Fundstrat, basically saying that in October for Halloween, they had their record sales of their pizzas at the food court. And those pizzas sell for about $9.95. So look, that is an inexpensive pizza pie when you compare it to other places. And this really talks about the K-shaped economy and the fact that people are gravitating towards less expensive products, towards less expensive food, because they have to. And if you take a look at the jobs report, I found two very interesting points. One is multiple job holders was up by 750,000 year over year. That's people that are having more than one job. And also people who, the number of people employed part-time for economic reasons, that increased by more than 900,000 from September. So these are individuals that would want a full-time job, but they can't. They have to have these part-time jobs because perhaps their hours were cut back. So this talks about that K-shaped economy, people that are gravitating more towards less expensive products, those pizzas from Costco. And look, I was just there the other day and I was looking at those food court prices. I said, it's hard to beat. You can get a soft drink for still 80 cents here when you compare it to a fast food place, $3.50 for a soft drink.
I know this is serious reporting, Inez. I'm just cracking up here. But no, Inez, hold on. We're going to hear a different message, I'm sure, from the White House at some point today. The economy's rocking. Things are good. We're going to see a manufacturing boom. Well, if that's the case, shouldn't Costco pizza sales be going down?
No, I mean, look. They offer a value, and they aren't, and they are keeping those prices the way they have for years now. And people are, look, you've got the people who are going from the 100,000 household incomes that are going to Walmart, that are shopping at the lower price point places. We've heard this over and over again. Affordability is a problem. This is something that the Trump administration is very much aware of, and we're seeing it in some of this data.
Chad, let me get back to you here, because while we're sitting here talking about rising sales of Costco pizza, two stocks that are not doing well, CoreWeave and Oracle, some of the really the hottest or the buzziest names this year. How concerned are you about these sell-offs? They're not just 5-10%. I mean, there's some serious routes here in the past few weeks.
Yeah, I mean, we owned Oracle for over 15 years and we sold it. The reasoning behind that is both of these companies are going to have to take on excessive debt to build out compute. That asset is going to depreciate at a nice clip. Mind you, there's a spot market for H200 chips. So that spot market is going lower. So it is a concern of ours that a lot of leverage and a lot of capital spending is happening in a nonsensical manner. And as that happens, it's going to accelerate perhaps some of the risk, not only within these two companies, but also on the private credit side.
Yeah, JP Morgan sharing your concerns in a note yesterday, Chad, on some of these debt worries. Is Oracle, Chad, a show-me story? Would you be open to buying it back if they come out with a good quarter and some good guidance?
No, because what they've done is they've levered their balance sheet, and they continue to lever their balance sheet. And this moved away from being a software company now to a hyperscaler. But they're creating a situation where you take the total amount of debt in the next 3 years plus leases, where it's just a much more levered story. And again, the price of compute is going to fall drastically. The other nuance of this is inference. A lot of this inference, the assumption is that it's going to be done at the data center side. If that is not correct and it's done on your cell phone with smaller models, then the price of inference and compute is going to even drop even more substantially. I would avoid these two companies at this moment.
Inez, let me get back to you here. Even though I'm running the risk of putting our viewers to sleep, I can care less at this point because I need to focus on debt. CoreWeave is a very leveraged play, and you heard Chad talking about the debt that Oracle might take on to fund its AI ambitions. CoreWeave is basically thriving on debt, and the stock is sold off here. How worried should CoreWeave investors continue to be even after this pullback? Because it looks like the concerns about their very operating model is starting to increase in a big way.
Yeah, and I think that that's what the street is starting to sniff out and is talking about this high debt that they are using to pay for the AI chips, which they will then lease out. So this is one of the concerns. Of course, you've also had the concern about the data center construction delays, but really those are, the high debt is now starting to bubble up as the concern for Wall Street. The margin squeeze is also is a concern. And so when you've got this, these are sort of the sounding alarm bells, and this is what also short sellers sort of like to pile into or like to point out when they start to short these kinds of companies. So this is the poster child for the AI infrastructure play when it comes to data centers and when it comes to leasing out chips. And this is the sort of poster child that you have seen now where its stock is down 60% from its June or July high.
Brooke, the only warm and fuzzy story I have this morning is Tesla nearing a record high.
Tesla, definitely about a record high here. And what we really know is that this company is really getting lots of momentum around those promising automated taxi rollout that we're seeing there. We know that for the first time, they're going to launch in Austin over the next few months without that safety driver within the vehicle as well. And that definitely has the street excited. And if you take a look over the past year, when they began to roll out this testing in about June, that was when we saw Tesla regain some of the momentum that was lost as Elon Musk got more and more involved in Doge, that government efficiency platform as well. And now we're seeing some really robust calls on what exactly this can mean for Tesla. Of course, Dan Ives, a bull on the street when it comes to Tesla, saying that this is a game changer and will define Tesla's future. Of course, these automated taxis really in line with sort of their AI platform. And that's why he sees the most momentum behind this stock is yet to come because of what exactly this can mean. And it's interesting to see this sort of play out in this backdrop where we did see Tesla U.S. sales in November drop for the lowest since January. We also have domestic sales fall about 23%, and yet there's such momentum behind what exactly this automated taxi service could become for Tesla that really the sign of where exactly investors are looking seems to be more focused on that.
Chad, what a different story. We have Ford coming out here with a $19.5 billion charge. I mean, that's not chump change. That's a serious write-down. That's very embarrassing for a company like that. Might get a very large charge from GM when it reports in a few weeks, too. And you have Tesla over here, pretty much now an AI-focused company. Yeah, they make cars, but they are trading at a record high. Like this three stories couldn't be more different.
Right. So this is the poster child of what's going on within the stock market. It's selling at 17 times revenues, and it's an EV company. And what I could say about Tesla is that we believe that the valuation is quite elevated. Buyer beware, because when it comes to autonomous driving, Waymo has been leading the pack. And then when you go overseas, look no further as the Chinese EV companies, and they're quite competitive at about a third the price of what Tesla's charging. And oh, by the way, they do too have autonomous driving. So then you shift the story and then you say, well, we're going to be a robot company. And that is also a highly competitive business as well. And there's not going to be a clear winner for many decades when it comes to the robotics.
And as I hope at some point Tesla takes their driverless cars and delivers us Costco pizzas and crushes a company like Domino's. I mean, you see it coming, Inez, right?
Oh, I see it coming completely, and I think that it's going to absolutely change our lives when we don't have to be behind the wheel ourselves driving. Look, but what some of the commentary that I've seen about this is really that AI flywheel when it comes to Tesla, going from robotaxis, AI chips to the humanoid robots, and all of it feeding into one feeding into the other. When it comes to data, when it comes to scalability, when it comes to everything that has to do with how these systems operate, but all under one umbrella. And you've got to hand it to Elon Musk. I mean, this is why he received the pay package that he received this year, because this is what investors want to see, being able to have that AI flywheel with this kind of company.
Shout out to our amazing social media team. Let's get a clip of Inez here talking about driverless cars delivering Costco pizzas. I need to see that on Instagram. A big thank you to our opening bid roundtable. Y'all crush it here. Really appreciate it. Straight ahead, I am drilling into the future for oil giant Phillips 66 with its CFO as it wraps up a big year. We'll be right back. Take a look at the price of oil dipping below $60 a barrel as industry faces an impending oversupply. Meanwhile, AAA says the average gas price is just $2.90 a gallon. In short, it's not easy to be in the energy business right now. Activist investor Elliott Management has been pushing Phillips 66 to focus on oil refining and spin off other efforts like its chemicals business. For a deeper dive on the oil and gas world, joining me now for today's Power Player, Kevin Mitchell, Phillips 66 CFO. Good to meet you for the first time. I appreciate it. Thanks for doing this. For those this is a sprawling business you oversee. I can only imagine the spreadsheets you deal with on a given day. Where are some of your priorities going into next year?
So looking into next year, we just announced our capital budget, $2.4 billion, very much focused on our midstream growth, specifically within the NGL value chain, and also continue to enhance our refining operations.
Within that midstream business, walk us through the operations. What does drive growth in that?
So the growth in that business is all oriented on the NGL value chain. So these are the liquids that come out of the natural gas production that need to find a home. And we process those liquids, we transport them, and ultimately the end products out of that, ethane, propane, butane, go into petrochemical feedstocks, into export markets for fuel and heat use, and also integrate with our refining operations.
Every day that we seem to be talking about, Kevin, the growth in data centers in this country, and we're building them at a rapid clip. How is this impacting the business of energy?
The major impact of the data center growth on energy is on power, so electricity consumption and demand, which we're not directly in that business. We're also a large consumer of fuel and power, but it does translate into the natural gas business because a lot of that power demand growth will be gas generation, and so indirectly we touch it in that respect with the handling of the natural gas and the liquids that come from that.
Outside of midstream, where else are you focused? I looked at the capital allocation plan. I didn't see a large allocation to the chemicals business. What gets the industry, out of that downturn?
Yeah, so there's a little nuance there that our chemicals exposure is within a joint venture and it's self-funded.
Gotcha.
So our direct capital budget does not have anything for chemicals, but CPChem is spending, our share of CPChem, 50%, is spending about $700 million on two major world-scale facilities, both of them joint ventures with Qatar Energy, one of them in the US Gulf Coast, one of them in Qatar. Both of them are able to benefit from low-cost feedstock.
Oil prices, like I mentioned in the intro, and they've come way down. How difficult has that made it for you in making profits from this business?
So it doesn't impact us directly in that we don't produce oil. We're a large consumer of oil into our refining operations. So for us, what matters is the margin between what the oil costs and what the finished products, gasoline, diesel, jet, what they sell for. And so a low price of oil, if it's not associated with weak demand across the entire system, that can result in healthy margins for the refining and marketing business.
Are you seeing healthy margins?
We have done. December, we've had the usual seasonal drop in margins, but through the third and into the sort of middle of the fourth quarter, we've seen very healthy refining margins.
We've heard it from the Trump administration that oil prices have come way down, like I just mentioned, and at some point, consumers will see this in gas prices. They will see it in their everyday lives. Like, when is that magic moment? When do all these things come together?
I think you're seeing it now. You look at pump prices, average street prices out there, they're about as low as they've been in, I think it's about 3 or 4 years. And so certainly under $3 per barrel national average gasoline price, and that's a very affordable level relative to where this has been if you look back at different points in the last 2, 3, 4 years.
Do you think further declines are likely?
It's certainly possible. A lot of it will depend on how OPEC responds with regard to their production cuts and managing their quotas.
The industry, of course, has gone through a major transformation, just given the change in the White House versus the Biden administration versus the Trump administration. How has this year been different compared to the 4 years under the Biden administration?
The primary difference has been the relaxation of some of the regulatory environment that we have been dealing with. You saw some of this with the One Big Beautiful Bill Act that was passed earlier this year. Has been generally energy friendly, although there's some challenges in that as well, especially with regard to the renewable fuels business, which we are part of that value chain as well.
As you look into next year, is there one thing you're hoping the administration pulls the trigger on that might impact your industry, good or bad?
The biggest impact for us will be around renewable fuels and the flexibility to run imported feedstocks in an area where we have invested, and imported feedstocks are disadvantaged right now. That's the biggest focus area for us.
From what I could tell, look, the company has been through a campaign with Elliott. There was no clear winner from this. Make the case. Why should your business stay together?
The business should stay together because we have both very real integration benefits between the refining, the midstream, the marketing, and also the chemicals business. Those integration benefits enable us to drive both more consistent and less volatile earnings, as well as enhance our returns on capital. And ultimately in this business, it's all about enhancing return on capital, and that will differentiate the winners from the losers in this business.
If you were to subscribe to some of their thinking, what would that mean to the earnings outlook for your business?
Well, some of their thinking is consistent with our own, which is around continuing to enhance operating performance, scrutinize, be ruthless around cost structure, efficiency. And so we're very aligned in that regard, and we will continue to execute on our plans around that. The portfolio breakup, we just don't feel is value creating from a shareholder standpoint when we look at what those scenarios would look like, whether it's either selling off large sections of the business or doing some other form of spin-off type of transaction.
Is it disruptive to have an activist like this as a top shareholder out there very publicly? I mean, can you do what you want to do from a management perspective?
Ultimately, yes. I mean, clearly it's they take a lot of our attention and focus, but at the same time, we listen to all of our large shareholders. Their ultimate objective is actually consistent with ours, which is to drive value creation for shareholders. And so in that context, it's a reality we have to deal with. We're very committed to driving the improvements that we've laid out, and we think that with the plans we're executing, they will be happy shareholders as well.
All right, we will leave it there. It was good to finally meet you. Hope you get some time off during the holidays. Now to get the capital budget out there.
Yep,
possibly.
Exactly. Yep,
all right, I appreciate
thank
it.
you.
All right, thank you so much, Kevin. Appreciate it. All right, coming up, Julian Hyman has you covered on Market Catalyst. Big chat out of the gate with Mohamed Al-Arian. Looking forward to seeing Mohamed on there. Don't go anywhere.